Hello and welcome to Lone Investor. So let's go over the market today and see where we are now with the updated data. So about a month ago, I talked about the earliest dates for Bowen, and that is somewhere in June. And the reason for my timeline is based on a few things. So first off, with the FOMC meeting confirming the either 75 or 50 basis points, and that will create some sort of a rally since the market has already priced in the worst. And then after the FOMC meeting, we have the CPI on May 11th. And for the CPI data, as I've mentioned before, I think we have seen the peak of the inflation in March data, and since April we have a fall of the oil price and the used car sales. I was predicting the CPI will be a little bit lower, and that should create some sort of better market sentiment. Then the next inflation data will possibly be even lower. So the FOMC meeting in June, the Fed might sound dovish again with the easing of rate hike. And before June, I was expecting the market to trade between these two range. As you can see, it didn't happen. So after the FOMC meeting, the next day, the terms stagflation start to come in, and it creates a whole lot of uncertainty again. And so a few days ago, I talked about stagflation possibility and with the data. So if you're interested, you can check this out also. But in short, my point is there is some data showing for stagflation, but I don't see it happening just yet. And as you have followed my previous video, I was expecting nasdaq to only drop to 12K, testing the tops here. I didn't really expect it to go below 12K, but since we're already here, then let's look at the next possible support that we will see. And that is back to the thumbnail picture here. So this is the weekly chart for Nasdaq, and this is the 200-week moving average. So you can see in the past, every time when it touches the line, it has some sort of a rebound, except for a few exceptions. I will talk about those in a bit. So you can see recently with the 2018 recession and with the COVID crash, it touches the 200 weeks moving average. So the 200 weeks moving average is sitting at 10.7K. So this should be the next strong support. And the lowest point today, we were about 400 points away. And as you know, for the past week, we do see some 400 points drop in a single day. And also there are times that we have almost touched the 200 weeks moving average. So the question this time will be, are we near the bottom or will we see a downside like the previous past? So as you see in the 80s and 90s, we have a little bit of dip down. But since these are 30, 40 years ago, there are different companies and the environment is very different than what we have now, so I'm not going to go over those two. So if you take out the most recent events, that would be the dot-com bubble bust and the 2008 financial crisis. So first, let's talk a little bit of the dot-com bubble. The dot-com bubble was the rise of the internet, so there were a lot of many different websites, a lot of IPOs coming in with the new technology. And this top was marked by overextend in terms of evaluations. So if you take a look at the nasdaq divided by the total money supply, we can see back in the dot-com bubble. So back then we were at 1.0, 1.08, 1.07, and recently the nasdaq top back in November was at 0.75. So in terms of a bubble level, it wasn't as severe as the one that we had during the dot-com bubble. And also since the internet was invented back in 1993, the market increase was much more parabolic compared to what we have right now. And if we compare the S&P to the money supply, we're at nowhere level near the dot-com bubble. And even with the recent years of the crypto asset and the crypto sector, it does not make up the huge portion of the Nasdaq index. And even if there's a burst of crypto asset bubble, it won't affect Nasdaq as much as before. So we're in a different macro environment comparing to the dot-com bubble. And as for the 2008 financial crisis, the market fall based on the housing bubble. So the people cannot pay off the mortgage, so they have to sell their houses at a loss. And there were a huge unemployment rates following after. And recently we have the talks of the rising interest rate, and then people are worried that we might see the whole 2008 happening again with people cannot pay off their mortgage and they have to sell their house, etc. So let's see how bad things have to get in order to have the similar effect of 2008. So let's talk a little bit of mortgage. So the average mortgage size is 450K, and for the past few years the average mortgage rate was about 3%, and currently it is rising to about 5%. And if you look back a little bit further, so let's say people who bought in houses with the past 10 years, I would say the average was about 4%. And in the past 50 years mortgage rate, the average is at 7.78%. But if we're talking about a 30 years mortgage rate, the people who have bought in from the 90s would have paid off their houses already. So I would say the rise of interest rate will mostly affect the new home buyers or people who have bought in with the recent years. So that's why I'm doing the 10 years with the 4% on average. So here we have a mortgage amount, so 450K with 3%, 4%, and 5% interest rate. Now the differences is a little bit off because after 5 years, so let's say you're at 3% and after 3 years you will have less mortgage, because this is a conversion of the beginning of the mortgage. So it's people who borrowed 450K from the start. And if someone is doing 5 years, and by the end of 5 years, if it raises to from 3% to 5%, their payment is 2,300 instead of 2,400, since they have paid off a little bit of mortgage during this time, but it's not off by too much. So let's just use this as a more simple way to see. So the people who have bought in these 2-3 years, as their average is 3%. So at 3% comparison to 5%, currently they're paying $1,900 for mortgage per month, and it will be increased to $2,400. So it is a $500 increase. So for average family, the increase of $500 is not too bad. I think it's still within the acceptable range without people having to not be able to pay off. So I think anywhere of an increase from $500 to $1,000 per month is still within the acceptable range. Although the family will not be as happy, but I think it's still acceptable. So at $1,000, it will put the interest rate at 7%, and I believe at the rate of $2,000 per month, it will get a lot of families in trouble. So that would be a 10% in terms of mortgage rate. So at 10%, we're really seeing the rates back in the 80s and 90s. And if you're wondering what the spike here is, that is when the inflation got out of control back in the 70s and 80s, when the Fed has to raise the interest rate aggressively, and that is what causes the spike in the interest rate here. So here we have the medium of, let's say, 8%. So at 8%, they're paying $1,400 more, and that increase is a bit more than the average family can save per month. So when families can't spend extra cash to buy items, that will cause us the slowdown of the economic growth. And then if they're spending more than they earn, then they will have to spend into their savings, hoping the interest rate will come back down before they empty their saving account. So that is why the comparison before of the interest rate hikes compared to the market. When the interest rate is going up, the market is still going up. And it wasn't until the topping of the interest rate, when people are eating their savings and etc. And that will usually cause the slowdown of economic growth, and that will make the market come back down. So if I put the rate hikes right now, so currently we are not at the top of the rate hikes yet. So in comparison to the financial crisis where we had the interest rate toppings. So since currently we're still at the beginning of the rate hikes, so I would say we're very similar to what was happening in here. But in reality, I think we're closer to be right here than over here. And here is why. Although the rate hikes is not at the top yet, but as I have mentioned before, the market has already priced in the rate hikes. And I have talked about the inverted yield curve, and the inverted yield curve usually happen before the recessions, and the recession usually happen after the spiral of the yield curve. As I've shown in here, so this is the percentage of the 10 yield curve inverted, and this data was back in the end of April. So as you can see, we have the yield curve inverted, and then we're spiking up on the percentage. And as you can see before, during the spike of the percentage, the market is still going up, the S&P is still going up. So based on the historical data, when it passes the 50% mark, that is when the market is very close to the top and then followed by a recession. So in order for the percentage to go up, either the 10-year bond yield has to go up or the 2-year bond yield has to come down. And also the reason why I say we're actually closer to here is because, as you can see, the 2-year yield curve has been spiking since August 2021, and you will immediately see what I mean if I put the rate hikes on top. The 2-year yield curve and the rate hikes is very closely correlated to each other. And as you can see recently, the 2-year yield already pricing the rate hikes before the Fed actually did anything. And if you remember my last video, I was talking about the economic growth, and I was saying the Fed already missed their chance to increase the rate hikes. And this is further confirmed by the 2-year bond yield, that the Fed has already missed their chance to increase the interest rate. And now that we already see the peak of inflation. As for inflation, in March it was 8.5%, in April it was 8.3%, although it is showing a sign of slowdown, but it is higher than the estimate, which is 8.1%. But I'm still considering March to be a peak of inflation month. And if you zoom in day chart, we can see a divergence in price with the RSI since the beginning of February. So in a technical standpoint, this needs to either consolidate or drop back down in order to have the RSI reset. And if it does drop back down with the slowdown of inflation, the Fed might not increase the interest rate as much. So in the past, just before the 2008 financial crisis in 2007, the 10-year bond yield dropped from 5.2% to 3.3, while the 2-year bond yield dropped from 5% to 1.5%. So the steeper drop of the 2-year bond yield versus the 10-year is what causes the spike in percentage. And as for the 10-year bond yield, I've traded it yesterday, that on monthly chart, we have never get this sort of a overhead stance on the RSI. And on day chart, once again, we're seeing a divergence in price and the RSI. So this either has to consolidate or come back down a little bit, but I'm guessing it has a high chance of coming down because of the peak of inflation. And I'm making a wild guess of this showing a head and shoulder pattern. So when it does happen, it put the time frame around in June, so just in the FOMC meeting. And the target price for the bond yield would be around 2.2%. Now at 2.2%, in order for the 50% mark to happen, so if the 10-year bond yield is at 2.2%, in order for the 50% spike to happen, the 2-year bond yield has to fall below under 1.1%. So that will create a spike of 50% while marking a market tops. So since 10-year bond yield and tech has an inverted relationship, so if the 10-year bond yield falls to 2.2%, similar to what we have back then, it will benefit the tech market. One last data to look at is the AA bull sentiment. So back in May 7, we were at here, and I was mentioning in the previous times when we are at this level, it corresponded to some sort of a market bottom except for the 2008 financial crisis. And this is updated yesterday. As you can see, we are even lower than what we had before. And with the nasdaq getting close to the 200 weeks moving average, and with the 10-year bond yield being overextended at the moment, I would say we're very close to a bottom. We might or might not have a little touch on the 200 weeks moving average, but when it does hit the 10.7k mark, I think I will do my final add-in as the risk reward ratio keep piling up into a more favorable term. So this is all I wanted to share today. If you like the video, do subscribe to my channel and give me a thumbs up, and I'll see you guys next time.